Hello, this is Genter. I'd like to bring you a brief update with regards to the current market conditions. Obviously, we are going to have a tremendous amount of volatility between now and the election. So the next 30 days are going to be probably somewhat unprecedented with regards to the cycles we're going to see in the market. The market clearly was overvalued, especially in the large mega cap growth stocks, which have now retrenched almost double what the overall market has retrenched, with the overall market down roughly 5%. And the mega cap growth's down double that amount. So we're seeing a little bit of the closing of gaps between growth and value, though there's still a significant chasm between the two. Despite this volatility and despite the variation in the different asset class subdivisions, we think that the overall market is developing a nice basing pattern. All of the economic data is improving, whether you look at unemployment, which is now down to 8.4%, well below what people were hoping, which was going to be a 10% number at the end of the year. Overall consumption, looking at PCE, basically almost every economic dynamic is improving considerably. So even though the market sitting at about a 21 PE, clearly overvalued by historical standards, but with interest rates near zero, with the Fed reaffirming it may actually stay there for years, the market is not dramatically overvalued as long as we see the economy continue to improve in the 5 to 6% range going into 2021. The market is clearly pricing in a Trump victory. With that, and with it being a statistical dead heat, certainly with the conclusion of the election, frankly, one way or the other, we think that we'll start to open up the economy. Earnings will continue to recover, and multiples will continue to move forward. Now, we do think there's significant value overall, not only in the value stocks, but in particular in the high dividend area. We're seeing many issues that are currently represented in our portfolio with yields well north of 4%, some north of 6%. So it's a very good place to ride out this situation, collecting 4.5%, which is only being taxed at 20%. And so it's very, very attractive. And I think for people also, there's really just no reason to exit this market. We're building some foundation. We're building some basing pattern. There's really no alternative. The bond market is clearly expensive. Money market funds are at zero. And you're in a position where, again, the other barrier to exiting is that most people have significant embedded capital gains. So that's a known liability that you would be incurring if you have a significant liquidation in your portfolio. So right now, I think as steady as she goes is really the course of action. Sit back, collect your dividends, buy into weakness, any individual contractions in these strong, high dividend paying names is really the way to ride out this near-term storm. So thank you for letting me spend a few moments with you.